Hello, everyone, and good evening. A very warm welcome and happy Mother's Day to all the incredible women and mothers joining us today. 11th May is celebrated as Mother's Day, serves as timely reminder of the care, resilience, and thoughtful planning that go into nurturing families and shaping futures, values that also lie at the heart of sound financial decision making. While self care takes many forms. One important aspect to be kept in mind is financial independence, which allows mothers to plan confidently for future with greater autonomy and less reliance on others. Inspired by this spirit, NISM is hosting a special investor education webinar advocating greater financial awareness among mothers, encouraging them to take charge of their financial journeys with clarity, confidence, and a sense of empowerment. Today, this session will be led by Ms. Lisa Pallavi Barbora, personal finance expert and author of Money and Her, and of course, a mother herself. She brings a wealth of experience and practical insights to help simplify money matters, making this session valuable. A little glimpse about NISM, National Institute of Securities Market, that is NISM, is a public trust established in 2006 by Securities and Exchange Board of India, that is SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels aimed at enhancing the quality standards in securities markets. Before we begin with this session, I request participants to kindly note some points. Questions will be taken at the end during Q&A segment. All participants will receive participation certificate within 3 to 4 days. The recording of this session will be available on NISM's YouTube channel. So now I request Lisa ma'am to take over the session. Thank you.
Hi, and thank you, Tanisha, for the introduction and for starting the session. And a happy Mother's Day to everyone out there. It's a really great day to be discussing this because financial independence is important for each and every individual. But for mothers, it's an extra special session because often in all our responsibilities and our duties as the caregivers in the family, we tend to overlook this part of our lives. Okay, so with that, I think I will get started. We have kept this as money and moms to kind of, give the special importance to the day that we have today. Financial independence is one of the most critical things for every individual, but it's not the easiest thing to kind of undertake, especially if you're starting slightly later in life. And that's why I've put this quote here, which says, I always get to where I am by walking away from where I have been. So anything in your life which requires a certain different outcome or change requires you to change the way you approach things as well. This quote is from one of my favorite animated characters, Winnie the Pooh, but it stands true for all of us in all across different aspects of life, but very much when it comes to our relationship with money. Okay, just very quickly, Tanisha did introduce me, but I'll just give you a little bit of background. I've been in the personal finance industry for around 20 years. First in the industry itself in wealth management, asset management, and then writing for Business Daily, Mint on personal finance for a very long time. And then I started out on my own freelancing with content around personal finance. Now, mostly that relates to investor education related content and columns which I write for digital media. And of course, I have published my first book, which is a personal finance book called Money and Her. It's a personal finance book with a difference because it's not just about the numbers, but also the mindset that you need to own your money choices. Okay, so with that, we can begin. Why this? I think what I want to just talk about first is the need for financial awareness, right? Why is there a tearing need today and every day for every single person to be financially aware, but for women more so? Indian women live at least 3 to 10 years longer than men. And this is, of course, not me saying that. It is the Sensex Commissioner's Office, which has found this to be true for Indian population. So women live longer than men. We know this empirically, historically. And in those years, the financial independence that you've accumulated throughout your life is what will hold good in ensuring that you live a comfortable life. Also, and this is relevant whether you are a man or a woman, nuclear families are growing, which means that the traditional setup where parents used to rely on their children to move in with them, to stay with them in their, so-called sunset years, that is changing. And we know that a lot of times children are in fact overseas and parents are back in India because jobs have become more mobile. It's no longer your hometown where you are living and working throughout your life. So that dynamic is happening. And another research done by Kentar has said that now 50% of all Indian families are nuclear. And this is as of 2022. And this earlier in 2008, as per the same research, was 37%. So this is growing. The number of nuclear families are growing, which means that as you move towards retirement, towards the post 60 kind of years, post earning years, you have to start thinking about your own independent financial ability to generate that passive income, to take care of your lifestyle, to take care of your wants, whatever they might be. And as I said, children are moving overseas. So the distance, while families are moving nuclear, the distance is also increasing physically. So it may not be a quick, transition in if there something happens. It may not be very quick that children can come or they can transfer money or whatever is required. So the more you focus on making yourself independent, the better it is for your own future financial security. You are responsible for your life's outcomes, no matter what age you may be. Okay, why are we talking about the need for financial independence, especially in your sunset years? If you look at how life is, there is a stage where we are all learning, which is from birth till say around 25 years. Of course, learning never stops, but I'm talking about the official learning period, which is from birth to around 25 years. Then you're earning, you have, you're building a family, caregiving, etc. So that is from 25 years till about 60 years. That's 35 years of your life goes in earning. But now, thanks to medical science, thanks to all the advances, it is also another 30 years where you'll have to be living without an active income. It could be more, but that's what you're looking at. And then you're just living, right? Is that a meaningful period of your life? Yes. And it's meaningful enough that you should not be dependent on somebody else to fund that period of your life. So if you approach 60 years without clear financial awareness, you are likely to be dependent on others for your well being. What does that lead to? It leads to, because that's a long period of your life as well, and it will slowly lead to a loss of self confidence. Because if somebody else is funding your lifestyle, you will have to somewhere, go along with their way of how to live. You will lose control over the choices that you're making because you will rely again on them for those choices. And you'll be forced to live a life that you don't really connect with, simply because you are not free to make your own choices. Financial independence will give you that freedom. So, what really is financial independence? Financial independence is your ability to have a say in your life's choices, no matter what age you are. It becomes more important in the years that you are not earning because you don't have an active income, and instead of relying on somebody else, you need to rely on your own passive income or the investments that you have accumulated over the years. So, along with earning, you have to understand your family's finances, you have to contribute to the family's financial decision making, and you have to be part of the retirement planning, regardless of gender. Why have I put these here? Because often women or mothers step away from these. Financial independence is not just your ability to earn, it is your ability to do all of this so that you have a say in how you live your life today and in the future. But why do women shy away from this particularly? And a lot of people shy away from sort of being proactive with their finances. Why is that? In my experience, I have found that the reason a lot of people shy away from this is because numbers scare people. They feel like personal finance means numbers, and nobody wants to, get into all these numbers. It's like your housing loan, insurance भी करना है, finance, pension भी देखना है, खर्चा भी करना है, save भी करना है. It boggles the mind. And I totally get that. But I'm also going to give you a way to get around it. If you are one of those people who feels that numbers boggle your mind, then let me try and simplify it for you. So the way to look at numbers really is not trying to complicate things. It's very, very simple. Your personal finance is just these numbers, and these are not difficult to understand. Income, that money that comes in to your family or your bank. Expenses, the money that goes out. Savings, whatever is left over. Wealth, what's invested and growing. Debt, the money you owe someone, so the loans. And inflation, very important because it's a fact and it eats into the value of your money, and you don't have control over inflation. So these are the numbers you need to know, nothing else. And this is not mind boggling, right? Because if you're earning, you know some of this already. If you're not earning, but you're part of the family's finances, then also you know some of this. Maybe some you know and some you don't know. So you just have to figure this out. If you figure this out, then you are on your way towards financial awareness and then eventually financial independence. But your first step is to understand that numbers are not complicated. They're simple numbers that impact your everyday life. And knowing these numbers is what is important to achieve financial well being. What is financial well being? It's your current financial health. Are you able to afford the lifestyle that you want today? Is your money working for you today? That's your current financial health. And your future financial security. Are you able to use your money in a way that you are also taking care of your future financial security? So, financial well being is a combination of both, it is not one or the other. Okay. And how do you achieve financial well being? It's, as I said, combination of current financial health and future financial security. And that can be achieved with a combination of capital safety and calculated risk. Capital safety comes from your savings, which will help in times of current emergencies. So your income probably takes care of most of your current needs and wants. but there could be financial emergencies as well, for which you need to have some savings in capital safe or stable return kind of investments. And for your future financial security, you need to invest such that you are able to grow the corpus. And that requires you taking some amount of calculated risk. We'll be talking more about this in the later slides. Okay, so this is a very simple thing that I'm going to talk about, but just this morning I was at a session, and even there I found that I think this basic fact kind of evades a lot of people. So I'm going to say it anyway. The traditional cycle of money is that we earn, we spend, whatever is left over is the saving that we use to invest. But if we keep doing that, if we keep using savings which are left over, we may not be able to achieve our future financial security. Why is that? Or our entire financial well being for that matter. Why is that? Because you see, leftovers, even when it's food in the fridge, are sometimes enough for an entire meal and sometimes not, because they're leftovers. You haven't planned for them to be enough. So if you only rely on leftovers, you may or may not be able to achieve what you want with your money. So how this needs to change is that you earn, you save first, and then you spend. Because then you know what is your exact saving amount. You're not relying on sometimes it's enough and sometimes it's not. So it's very, very important when you look at your entire personal finances. This is where you begin. You earn, you save first, and then you spend what's left over. Okay, so now one last thing around inflation and financial well-being. I said inflation is very important because it eats into the value of your money and you have no control over it. Well, yes, you have no control over it. And this is how it eats into the value of your money. In India, we have about 5 to 6% annual inflation. And at that level, your money will become around half in 10 years if you don't do anything with it. So if you leave 100 rupees as is, after 10 years, thanks to inflation, for no other reason, your 100 rupees will be worth 55 and a half rupees, which means what you could afford with that 100, you can only afford half of it. This means, and this is really critical, this means that you need to invest your money in such a way that you are at least beating inflation. If you're not beating inflation, you are not growing your 100 rupees at all. And to grow it meaningfully, you have to beat inflation by some meaningful margin, right? Not just inflation. So today, for example, the bank fixed deposit rate is 6.5% for 1 year. And that's barely beating inflation. If it remains that for the next 10 years, after 10 years, if you've left your money in a bank fixed deposit, you have really not grown it. Because the value of your money, you won't see it, it'll still be a 100 rupee note, but its value is worth half. And on that, you have earned, not much at all, because even if it is 6.5 and you're saying thoda to zyada inflation say, but there is a tax involved in that. So you really don't earn. And that is why we had put calculated risk in that financial well-being equation, because that's most important in order to beat inflation so that you can grow your wealth, so that you are prepared for your financial future. Now, we were talking about retirement, sunset years, remember, and why it's important to plan for it, because your earning years of 25 to 60, you are more or less happy that you have enough money and you are earning and you're taking care of your needs and wants. But it's after that when the active income either slows down, for some people it'll slow down and gradually trickle and stop. For some people, it'll be a abrupt end, abrupt stop, where they are working in organizations which retire you at a certain age. Now, these are estimates. These are not numbers which kind of, it can move in a range. So any which way you estimate it, what has been found is that for retirement without frills, that means to basically take care of your expenses, you will need roughly 25 times your annual expense at retirement. And the more you want to add to it, so add indulgences, you need a little bit more. Add inheritance if you want to leave behind money for your dependents, for your children, grandchildren, then you will need even more. Of course, it depends how much you want to leave behind, etc. So this is not an exact calculation, but this is what you're looking at ballpark. So which means that if at retirement, which means at 60 years of age, we're assuming that to be the retirement age, you have 1 lakh worth of monthly expenses, you will need 12 lakhs worth of annual expense money, and your retirement kitty should be at least 3 crores. So this is again just an example, not to say that this is how it will be for you, but as an example, if your monthly expenses are 1 lakh, then at age 60, you will, and this is at age 60, then for your retirement kitty, you need 3 crores. Of course, assuming that the house is owned, so you're not paying any EMI or rent, and you don't have any extra medical expenses. Whatever you have is covered with your insurance. Okay, step two, how do you build this retirement corpus now that we know we will need this kind of money at retirement? How do we build it? So you have to be specific about the goal. Remember, it began with what are your monthly expenses and hence your annual expenses at age 60. So it begins with that. You need to estimate that as accurately as possible, because that will mean that you can estimate accurately how much you'll need for retirement. How much do you need to save today to achieve this corpus? Again, as an example, at an assumed rate of 8%, to achieve a 3 crore corpus, which we spoke about, in 15 years, you need to invest 90,000 a month. Okay. Then you have to choose where to invest. Okay, so how do I get this 8% return? So for 8%, you need 50% in equity and 50% in fixed income. We've assumed a kind of return. And then last step is to pick the investment products. So building a retirement corpus is not a difficult task if you go step by step. First, you estimate how much you'll need. What do you need to put aside today to achieve that corpus? Where should you invest? And which are the investment products you need to invest in? Okay, so before I go to the next thing, I just want to put in a word here that investment products can be many. Today, I'm going to talk mainly about mutual funds. Why is that? Firstly, some of the traditional older sort of government-backed investment products, small savings products, like PPF is there, NSC is there, the post office deposits, recurring deposits are there. Those returns have been moving lower. PPF is giving today 7.1%. Your post office deposit is giving, I think, around 7.5%. So these have gone lower. And just relying on these again will not help you grow your corpus. While PPF is tax-free, others are not. So you have to, account for some additional kind of return. The senior citizen certificate does give a higher return, around 8.5, 8.2, I think. However, there is a maximum limit and there is a lock-in. So there are all these things. There are other market-linked options as well, like NPS, and those follow the same principle by and large as mutual funds do, except that even there you don't have access to all your money and you get access only at retirement. So at retirement, that money comes out. And then you have to, again, do something with a lump sum. At least 60% of that money comes out. So you have to do something with that lump sum. So for the sake of simplicity and for the sake of explaining how to build this portfolio, we are going to stick with mutual funds, which are flexible, they're easy to access, and you can build an complete retirement portfolio using just this one form of investment product. Okay, now as we are going to continue with the same example as before. So the annual expense at retirement we've estimated at 12 lakhs. So the minimum corpus you need, as I said, 25 times is 3 crores. And let's assume retirement is 15 years away. Scenario one, your current portfolio, you can generate 8% return, which is conservative. Scenario two, 10% return. Scenario three, 12% return. The more calculated risk you add, the higher your return can be. The higher your return is, the lower your monthly contribution needs to be. I say calculated risk again and again because risk can be of many types, but calculated risk means that you know what type of risk you're taking. When it comes to long-term growth assets like equity, the risk is that in the short term, it can be very volatile and move up and down. However, if you've invested in good quality funds, good quality products, then over a period of time like 8 to 10 years or more, that short term volatility smoothens out and the returns pretty much track the the fundamental earnings growth of the underlying securities. And that, hence, it's important to have good quality. And that's the calculated risk. We are saying that, okay, I'm going to overlook the short term volatility because I want to remain invested for the long term. So you have to add some of that if you want to have a slightly higher return. How that helps is it reduces your kind of investment amount and it gives you the same result. So it increases your playing field in a sense. Okay, this is how you can think about how to start investing. Now, using mutual funds for your retirement corpus, as we mentioned in the previous slide, there are three scenarios which I'm just taking examples through. So 8%, 10%, 12%. Now, how do I build a portfolio to achieve this kind of a return? That's what the next slide is about. For a 12% return, which is the highest in our taken examples, you have to add some equity and we will also keep some stability through fixed income mutual funds. Here, again, for the sake of simplicity, I've just broken it to equity and fixed income. But there is also, mutual funds also give you access to investing in gold as well. But for 12% return, your equity portfolio needs to be robust and you can have a portfolio that actually has the potential to deliver these returns. Again, none of this is assured. This is just what we are estimating. Okay, so you for a 12% potential return, you need an equity portfolio which can potentially give you a slightly higher return, which means you need to include things like large cap, mid cap, small cap funds, and at least 80% of your allocation should be to equity, with 20% allocation to fixed income through short-term debt funds. So no risk in fixed income. Excuse me. So we are taking no risk in fixed income. Excuse me. And we are just investing for capital safety. Now, for 10% per annum.
Lisa, please have some water. We can pause for a while.
Just give me a second. I think I'll have to get up for the water.
Yes, sure, sure.
Sorry about that. We can start now. Okay, so as I was saying, for a 12% return, you need slightly higher risk in equity. And for a 10% return, your equity portfolio need not be as robust. So you can have large and mid caps. You don't need to go that extra mile into more risk. And but you still need 80% in equity and 20% in fixed income. And for an 8% return, you do need a little bit of equity exposure, but it can be only 20%, and bulk of it can come from the short-term debt funds. Again, these are assumed returns based on what the past experience has been for long-term returns that equity funds and fixed income funds, short-term debt funds have given. But it's not a guarantee or even something that's assured, but it's more based on historical data. One thing is clear that the later you start, the more you will need to invest. So again, the assumption is the same. I'm just showing you, what do you say, certain numbers, right? If your retirement is 25 years away, you'll need to invest for that 8% basic return that you need to achieve your retirement corpus. You need to invest 33,000 per month. You delay it 5 years, you need to invest 52,000 per month. You delay it 5 more years, you need to invest 90,000 per month. So if you're 5 years late, you need to invest 60% to 75% more. If you're 10 years later, then you need to invest almost double, 175%. Okay, this is how assets are stacked. This is only for your information in terms of risk. Unless you take a little bit of calculated risk, as you saw, you will not achieve the return that you need to grow your money so that you have enough for retirement, right? And this here is where your different assets lie, simple assets lie on the scale. You need to understand that there are different kinds of risk. You may think that if cash has no risk, why don't I just keep it in cash? You can, but you will not make the return you need. See, the return is also going to be very, very low. So keeping everything in cash, yeah, no risk, but no return either. Gold has done really well in the last 2 years, but there is no guarantee that gold will keep going up like this. There are certain extraordinary circumstances across the globe which have led to what gold is doing today. But again, gold does not have any income of its own, which means there's no dividend or interest that it pays out. So relying only on price can get a bit risky. Gold, however, is a great hedge for inflation. So having a little bit of that in your portfolio is good. Most financial advisors do not advise more than, say, 5-10% of your portfolio in gold. Fixed income, again, depends on how much you have to invest towards what goal. If your retirement goal is very large, you may not want to start with too much in fixed income because the returns are limited. Equity shares, yeah, they are riskier than these things, but the risk, as I explained, is a calculated risk. You have to focus on quality and you have to focus on long term. So you cannot invest in equity for a year or 2 years because it is very volatile. But the calculated nature of the risk is that you have to invest for 10, 12 years so that you can achieve what the asset is meant to do. But quality is most important in this respect. Okay, so how do I begin investing for retirement, right? So we have spoken about mutual funds, which I believe are the simplest option for investors who do not want to get into too many things, right? So for some simple schemes that you can begin with. So large cap equity, which will help with that compounding and the inflation beating returns. For long-term wealth creation, Sensex Nifty based index funds on Nifty Next 50 based index funds. These are going to help you achieve that inflation beating part of your portfolio return, short-term income funds or short-term debt funds for capital preservation and stability with high quality portfolio so that you're not taking any risk in this part of your allocation, and low expense ratio so that it comes at a cost which is not taking away from your yield. There is something called multi-asset funds which have come up recently, but they work well. They are a combination of different assets like equity, fixed income, and gold. And they are a middle path for both growth and stability. So, funds which have a good performance track record, established asset manager, and an expense ratio, annual expense ratio. These are all things, they're a bit technical terms, but they are all things which are mentioned when you are going to buy any of these funds. So, an average expense ratio, which is within the category average. Look for these are the simplest ways to start building your retirement portfolio. And how can I have a mutual fund discussion without saying that you can start by doing a systematic investment plan, which basically means that you invest every month, define the amount as we had defined in the previous slides. If I want this corpus and I am okay to take this much risk, so I'll get this much return. How much should I invest today? Invest that amount every month. You can define the amount, you can choose the date, you have the flexibility to increase the amount if your earnings are going up. You have the flexibility to withdraw in case of a severe emergency in your life. You can start an SIP regardless of the type of the fund that you want to invest in. And you can have SIPs running in more than one fund. So retirement may not be your only goal. So you can identify the goals and you can have different SIPs around them. So it gives you the reason everyone talks about it. And the reason it works is because of the extreme flexibility that this facility has to invest across different types of mutual funds. And it kind of fits in without much bother because all you have to do is give the mandate once, and then once it's running, it's automated. So you don't have to do it every month. You only revisit it every 6 months, 12 months. Want to increase it, you increase it. Want to reduce it, you reduce it. Want to withdraw, you can withdraw and move forward from there. So this is the simplest way to start taking care of your financial well-being. It can address your current financial health also, enabling you to start SIPs in the most low risk part of the mutual fund products, which is liquid funds, or you can start your future financial security by investing in a combination of different assets and building your retirement corpus. So that's it from me. Build a clear and confident relationship with money. Remember, money is only a tool. It will take you wherever you wish, but you are going to be the driver, right? So always keep that control and you can start today taking charge of your money. So if you have any questions, I'm happy to take that now. Any doubts, I'm happy to take that now. Okay, I'm seeing anyone wants to ask questions. I think you can just put it in the chat box, or I think there's a Q&A separate box, so feel free. I have one question here which says, I'm very much confused about which index fund to choose for long term. As I mentioned, you can choose the index itself. So the most basic are Sensex and Nifty 50 because they represent the large cap section of the market, which are the market leading companies. Those two indices are also the benchmarks that are used to represent the Indian market itself. So that's the simplest entry into investing in equity. Now, what is an index fund? It's any fund that is created to mirror these indices. Okay. So the index fund will have exactly the same stocks which are in the Nifty 50 index, for example, and nothing else. It will have the same stocks in the same proportion. So whichever index fund you choose, when you say which should I choose, you need to choose the underlying index, which, as I'm saying, you can begin with the benchmark indices. Whichever asset manager it is, it won't matter because the structure of the index fund will be to mirror the index. So all the index funds will actually have the same stocks in the same percentage, which mirror the benchmark that you're choosing. Don't begin with the more complicated benchmarks, and go down the order. Begin with the simplest, which are the large cap indices, and start investing. You can invest through an SIP in an index fund also. Okay, someone is asking, should we invest in gold as price is high now? So as I mentioned, gold is a tricky asset today because prices have shot up in the last 2 years or so. But if you track the history of gold, it's not that prices always increase. There was a long period between 2012, and I'm talking about the near history, so I'm not even going back to before the 2000s, but there was a period between 2012 and 2018 or 19 where gold prices did not go up for that entire period of 7 years. And because in case of gold, there is nothing underlying, right? So when you invest in equities, you're investing in companies and their stocks. Those companies are doing something. They're selling a product or a service. And by selling that, they are making money and they're earning profit. And that profit is the basis of the stock price. But gold has none of that happening at the back. It's just a demand supply, right? Gold does not even pay you interest. If you invest in bonds or deposits, you get an interest. Gold is not paying you any interest. So it's only price we are relying on. What happens tomorrow if the price crashes? So gold is a good asset to hedge your sort of inflation risk. And as I said, financial advisors usually stick to advising 5 to 10% of your portfolio in gold. Your jewelry is not an investment in a sense, because when you go to sell your jewelry in the market, you won't get the price that you paid for it. You'll get a lower price and the making charges go out, etc. So don't take that as an investment. If you're going to invest in gold, keep it to about 10% of your portfolio. And don't increase now because prices are going up. But if you don't have any gold in your portfolio, slowly start adding. Again, don't go out and outright buy chunky amounts, but slowly. Okay. Any other form of gold other than physical gold? Any form of gold you buy, whether you buy it now or later, it's the same thing because the price is going to be the same, which will be the market price. There are many other forms of gold which you can invest in. There's e-gold. There is the sovereign gold bonds have been, I think new tranches are not coming out, but that was a good way to invest. And of course, mutual funds have gold funds, gold index funds, gold funds are there where you are, when you buy one unit, it is equated with the market price of gold. And when you sell it, it will be equated with the market price of gold at the time you sell it. So it's like buying physical gold. It's the same, the return remains the same. There is a small expense ratio involved, which is not very big. It's up to about 1.5% to 2% a year. But that's a way of owning paper gold in a sense, rather than buying physical gold, where you have to check quality, where you need storage, and all of those other issues are there with physical gold. Okay, should I work with an investment advisor or do I pick funds on my own? That depends on how much you know about funds. It's always advisable to have an investment advisor, not just to pick funds, but because a lot of us have day jobs which are different from, this job of picking funds, etc. And the actually the variety of funds you have now, whether it's equity, debt, multi-asset or whatever it is really, really wide. So it does get confusing. Which asset manager should I use? What returns should I look at? What does performance track record mean? Rolling returns, so many things to look at. So having an advisor is always better. Also, in times when markets are chaotic, advisors can guide because they have kind of seen different market cycles, and they can guide you appropriately how to invest. Advisors can also build your entire comprehensive financial plan based on different goals, because every goal is going to require a different asset combination, just like we saw how retirement requires this combination. Now, how do you decide, should I go for an 8% scenario, potential 12% scenario? So advisors can guide with this. So it's not just about picking funds, it's about the entire planning around it and around the outcome that you want to achieve based on what you need to invest for. So yeah, I mean, it's always good to do that. For an aggressive investor which has long-term horizons, shall I go with Nifty, large mid cap? Okay, again, I don't advise on funds, I mean, specific products, but yes, if you have a really long-term investment horizon, then you can add more calculated risk, which means that adding mid caps, small caps is fine where your investment horizon is, long, like 20 years. Okay, let me see. Which fund is better, large, mid, flexi, index for long term? All funds, all these are fund types. These can all work. For large flexi cap funds, if they are actively managed, you will have to select the fund manager, like which fund, which asset manager, which mutual fund house is selling it, who's the fund manager. That's the tricky part, selecting good fund managers. And how do you select that? Index fund, that risk is not there. It's the basic, simplest form to begin with. Is at the end of the term of SIPs at the age of 60 years, total corpus transfer to a fund starts as SWP. That's up to you, right? You can start an SWP from your corpus, maybe not your entire corpus. So here's how you can look at when you are starting retirement, right? When you are starting retirement, let's say you have a corpus of, I'll just use what was in the example, 3 crores, right? And your retirement is, let's say, you are estimating 30 years. So you don't need the entire 3 crores immediately, right? So you don't need to start withdrawing from it immediately. What you need for the next 5 years, take that out and maybe put it in a stable return kind of fund, ultra short term fund or a short term fund where, again, the fund will earn something, but it is not going to earn something that is, it's not going to take risk in that sense. So you can then shift money for the next 5 years into a stable return, low risk fund and start an SWP only from that. Then, when you're 1 year away from finishing that 5 years, you shift more money in, and you can keep doing it that way so that the rest of your money is still invested for long term compounding and inflation beating returns. And what you need in the immediate 3 to 5 years is in low risk, stable return where you can start an SWP and start withdrawing. Which is better to invest, SIP or index fund? So, SIP is a facility to invest in mutual funds. It gives you the ability to invest regular defined amounts every month at a defined date of your choosing and the amount of your choosing. You can invest through an SIP in an index fund. Index fund is a type of fund that you're choosing to invest in. You identify the index you want to invest in, as we were talking about large cap indices. So Sensex or Nifty 50, you choose and you use an SIP to invest in those indices. Through an SIP, what happens is, say you have 1 lakh rupees, you don't need to invest the 1 lakh all at once. You can invest, say, 10,000 rupees a month. So SIP is a facility attached to these funds. It's not a separate investment option. How about factor-based index funds, which compared to market cap-based index? So as soon as we get into factor based, it starts to get complicated because somebody has chosen those factors, somebody has put them in. Factor based work, again, some factors work in certain market conditions, some factors don't work in certain market conditions. What we are talking about is building the simplest form of a retirement portfolio or simplest form of an investment portfolio. And as soon as you start adding conditions, which is what factors are, you are adding on one more layer, which can work in certain market conditions, maybe not in others. So it is a little bit of higher risk in that sense. And unless you understand those factors properly, or unless you have an advisor taking you around it, it's best to just stick with the simple stuff, I think. Okay, so I think I have gone through all the questions. Yeah, Nifty 500 is a broader index. That's also fine. Somebody asked Nifty 50 versus Nifty 500. So 500 is a broader index. That's also fine as long as you're sticking to, the larger market rather than anything specific, thematic or sectoral, which becomes very, very narrow. Someone's asked about silver. Silver is a commodity, again, similar to gold. So remember, price is the only thing. So the risk there is that if price doesn't move up, then what do you do? I don't track gold or silver, so I can't say whether it's a good time or not. There are no more questions. Remember, the focus really, I want to just, before I end the session, go back to, yeah, this slide. Any goal, and here we have taken the goal as building a retirement corpus, but any goal has many steps before we come to the investment products. And since most of the questions were around investment products, I want you to also focus on what happens before the whole process of saving, making sure that you are able to have the cash flow to invest in those products. That's really important. Your savings rate is going to determine how much retirement corpus you have before the investment product itself. Because if your savings rate is low, no matter what investment product you choose, you may not end up with enough of a corpus. Okay, so thank you very much, everybody. And I think I've managed to answer most of the questions. I hope this was useful for everyone. And if there are any queries, any more questions, feel free to get in touch with me. I operate as a financial coach. If you have any trouble with your, getting started with your investments, definitely do get in touch. Thanks a lot for listening. A very happy Mother's Day. Hope this was a useful discussion for everybody.
Yes, ma'am. I would like to extend our heartfelt thanks for taking the time to speak at our Mother's Day special webinar. Your insights, expertise, and engaging presentation made a lasting impact on all of our audience. Thank you once again for sharing your time and knowledge with us. Wishing you a wonderful day ahead. Thank you so much.
Thank you. Thanks a lot, everybody.